From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Friday the 22nd, 3 p.m. in London, 10 a.m. over in New York. We're 30 minutes into the trading day over in the US. From London, I'm Guy Johnson. Taylor Riggs in New York. Alix Steel has a well-deserved day off today. Welcome, everybody, to Bloomberg Markets. Taylor, stocks going sideways. The story is Snap.
Yeah, unbelievable, Guy. Why don't we just start there? Take a look quickly here at the S&P. 45.49 was the record high that we had yesterday. We're trying to hold on to those. You're still up about 3 points, but like you said, 0.06%, sort of moving sideways. Technology is the big underperformer. Why? Because you mentioned it. Snap off now 24%. At some point, looking at the worst decline that they have had on record. And the 5-year yield, Guy, I know we're going to talk a lot about some of the inflationary pressures. Yields are falling today 2 basis points, but really this has been an inflationary story. Yesterday, the 5-year yield used a strong tips auction because of inflation, and yields were the highest going back to February 2020. But I think you said it right here that Snap was the big story. I want to bring in Mandeep Singh here, of course, senior technology analyst for Bloomberg Intelligence. And Mandeep, I think what is so interesting to me is all the notes I read said that Facebook had been warning of the change of the Apple iOS. Snap management had really said that it wasn't a big deal. Did we wake up yesterday and figure out it was actually a bigger deal than we thought?
Yes, absolutely. And I think some of it was a function of just, Snap's valuation. So what we saw yesterday was, Snap obviously trading at peak valuation, taking a hit because it really set such high expectations that they came out of nowhere and said, Apple's IDFA changes will have a drastic impact going into next quarter. And some of it may have a read-through on Facebook and, Alphabet as well. Our view is, look, Snap is one of the smaller players. IDFA will have a much bigger impact on these smaller companies like Twitter, like Snap, and Pinterest. The larger ones like Facebook and Google will continue to do well. They can fend off, the IDFA changes or handle that much better. So in a sense, I think what we saw yesterday from Snap was a function of just stock being priced to perfection, expectations being too high, and valuations being so rich that there was no room for a miss. And that is, what exactly they did. So some of the multiple compression was warranted. We saw that with Pinterest. And I think it'll be interesting to see if the other ad companies corroborate, what Snap told us yesterday.
I thought it was interesting what they were saying about advertisers, though. Why does GM need to advertise a car that it can't sell? Maybe this supply chain story is going to eat into these business. Mandeep, we'll leave it there. Mandeep Singh of Bloomberg Intelligence on what's happening with Snap. Big drop, big drop. President Biden acknowledging that he doesn't have enough Democratic support in the Senate to back his proposed increase for the U.S. corporate tax rate. That's given fresh impetus, of course, for negotiators to find other revenue sources for the social spending bill. Let's go to D.C. now. Bloomberg correspondent Anne-Marie Hordern with the latest from the White House.
Yeah, good afternoon, Guy. Really, that town hall, we got a lot of news about what is going on with the president's economic agenda, Build Back Better, almost an airing of the dirty laundry. And he admitted that they're not going to be able to raise the corporate tax rate or the income tax rate because he doesn't have the votes. He has to get every single Democratic senator to vote on board. And he pretty much gave a nod to how difficult it is yesterday. Take a listen.
When you're in the United States Senate, and you're a president of the United States, and you have 50 Democrats. Every one is a president.
A little bit of insight, Guy and Taylor, into the power each individual senator has right now. When you look at what's going on with the taxes, this really hones in on one specific senator. That's Kyrsten Sinema of Arizona. She is not on board with the original plan of lifting the corporate tax rate and the income tax rate, but potentially some other options. A billionaire's tax, potentially a tax on buybacks. But now they are going back to the drawing board to figure out how are they going to pay for this, because the president said it would not add to the deficit. And the continuation of the negotiations continue today. We do have Speaker Nancy Pelosi at the White House this morning. She'll be having breakfast with the president, and Senator Schumer will be virtually zooming in.
Bloomberg's Anne-Marie Horton, thank you there as always. We pivot, of course, to some of the news in D.C. to the economic news that we're getting this morning. Growth in U.S. services picking up, expanding the most in 3 months. Manufacturing growth, though, cooling a little bit due to, you guessed it, supply constraints. For more, let's bring in Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. And Ira, is this sort of what we're thinking, right? We've seen the inflationary numbers. We've seen the supply constraints. Is it the pivot back to services?
Well, it looks that way, at least temporarily. I think one of the big questions is how much will the supply of labor constrain the growth of the services sector? So even though there might be better PMIs for services, can that be sustained without having additional hiring? So we're going to be watching very closely how many entrants come back into the workforce and at what wages they're needed to come back in. You mentioned a little bit earlier at the top of the show that the TIPS auction yesterday went pretty well. Actually, when you look at some of the details, the bid to cover ratio actually fell from the previous auction, and we had a pretty weak 20-year auction as well. So demand for treasuries is certainly waning a little bit, and I think that, regardless of today's little move down lower in yields, in aggregate, I don't think that demand will be sustained, and we're going to wind up probably seeing higher yields in the future, particularly if the Federal Reserve does taper as we expect on November 2nd. And on top of that, higher inflation is certainly going to weigh on yields, at least temporarily.
Yeah, it's interesting what you say about what's happening in the services sector. Ira, thank you very much indeed. Ira Jersey of Bloomberg Intelligence. Just to kind of go back through the data, U.S. manufacturing PMIs 59.2, that's down from 60. Services coming through at 58.2, that's up from 54. The composite number 57.3, up from 55. So actually relatively strong data, though you are clearly seeing, if you lift the hood, some quite alarming situations developing when it comes to the supply chain shortages. Interesting that that's now even bleeding through into the tech sector. European PMIs this morning, a mixed story, but the manufacturing supply chain issues absolutely present there as well. Let's talk to the man that put all this data together to give us an insight into what we should really be learning from it. Chris Williamson, IHS Markit's Chief Business Economist, joining us now. Let's talk, Chris, about what the message from all this data should be. What is your takeaway? Lift the hood, as I say, on the numbers that we're seeing.
Yeah, you really do have to lift the hood at the moment. The manufacturing PMI in particular, so this is an index, it's a composite one based on a variety of gauges like output, order books, delivery times, and inventories and employment. Delivery times is the key one. Normally, that's a good signal when they lengthen. It means everyone's nice and busy. But at the moment, they're lengthening because people just can't get any supplies at all in some cases. So this is a negative thing that it's unusual at the moment. So don't look at the headline PMI so much. Look at the output data. And there, if you see what production itself is doing, it's a much weaker story in manufacturing in the US and in Europe at the moment. So you've got in the US, actual manufacturing production growth slowing now to where we were at the start of the rebound from those initial lockdowns back in 2020. So the weakest gains that we've had for about a year and a half in the US, and we're seeing that in Europe as well. And that's due to these supply chain constraints, which they're getting worse. There's still no sign of these getting better. We talked last month about how they seem to be getting worse and worse and worse. And indeed, that's the case in October. So now across the G4 economies, we've got flash data for the US, the Eurozone, UK, and Japan. Put all that together and look at their supply chain situation. And the lengthening of delays was worse than we've seen in 20 years of data collection in October. So this is getting worse.
Right, and getting worse, what does that mean for prices, both input and output?
Going higher at an increasing rate. So unprecedented rates of input cost inflation we're seeing in the US and Europe at the moment, feeding through to selling prices going up. And this is not just manufacturing, it's feeding through to services. There's a whole load of inputs into the service sector, which are manufacturing based. But what we're also seeing, especially in the US and UK, is wage growth. Labor shortages, driving up wages. You saw some nice uplift in the employment gauges in October, and that reflected companies being prepared to pay more, to get more staff in, bucking the trend of weaker employment growth that we'd had in prior months. Companies facing reality, you got to pay more. And those employment numbers have come up nicely. Less of an issue in the Eurozone, where there's not so many shortages, but it's definitely a big factor in the US and UK. Now, these gauges, they have a nice correlation with CPI inflation. They move ahead of inflation. So the signal here is you've still got some further increases in CPI inflation to come through in coming months.
Chris, how much of this is coming out of China? We're seeing an economic slowdown there. We're seeing shortages there. That's where a lot of these supply chains seem to start.
Yeah, well, it's not just China, Guy. It's across Asia as well. So we had lots of factory shutdowns due to the COVID Delta wave that rampaged through Asia. Now, in September, we saw some turnaround there. It's going to take a while for these supply chains to improve, but we're getting some better production data coming out of Southeast Asia and China from September. It's going to be very interesting to see whether that persisted into October when we get those further PMIs at the beginning of November. At the moment, there was a sign that they're beginning to improve, indeed in China as well, but this is where it's all emanating from still. If we need COVID to be under control in those economies to ensure consistent production and hence consistent supply over to the US, over to Europe. Yeah. And there's no sign of that really coming through at any sort of consistency yet. So suggests that these supply delays are going to be here for some time.
You know, Chris, just quickly here, the economists and the Federal Reserve keep telling me this is transitory. Are they looking at different data?
Listen, they've been saying it's transitory for quite some time now. Just how long is transitory? This is stickier than anyone thought. It's going to go on through to next year. The thing is, nobody's individual interest rates, if you hike them, are going to do anything about these supply chains, right? They're not going to help improve. In fact, you need lower interest rates to try and stimulate more investment to get more production capacity built over in the US, over in Europe. So it's an unusual dilemma at the moment. But these are certainly not as transitory, not as short-term as anybody thought a few months ago. And these data today are the first real sign that it's still getting worse. There's no sign of these forces abating yet in terms of inflation.
Chris Williamson, IHS Markit, Chief Business Economist, thank you. Really appreciate your time. And Guy, coming up, the next guest also says inflation, it's not transitory. Bull Tick's Cathie Rooney joins us next. This is Bloomberg.
The choice of doing nothing is not an option.
We've seen an accelerated increase month after month after month of just a surge in demand for goods driven by e-commerce, but also this shift away from services towards goods.
It is definitely a market in flux, and just unlike, the recession or the bankruptcies or the tsunami that have caused inventory shortages, it's just different because it really is a supply issue, not a demand issue.
The cost has gone up 30 to 40%, and the volume is running up to probably 20% right now, and will even be more as the year goes on or as the fourth quarter peak season hits us.
The bigger issue right now is the labor force in the United States, and specifically getting more truck driver and truck capacity and getting more warehouse capacity through labor in our distribution centers.
Some key voices from the logistics industry speaking to us about what is happening with the supply chain squeeze that we were just talking to Chris Williamson about. So let's get another voice in on the conversation. Cathie Rooney, Bull Tick Capital Markets Chief Investment Strategist, joining us now. Welcome back, Cathie. You see a world in front of you that you say has been progressing towards this kind of narrative for a while. You reposition for it. My question is, do you think the rest of the market is now behind the curve?
Yes, we repositioned for it 1 year ago. It was a combination, Guy, of both an opening of the spigots from the fiscal side. Of course, the monetary side, we had spigots open for the past, more than a decade. But then the reopening trade and the bottlenecks that we've seen in the supply chain have exacerbated what we have foretold would be an inflationary scenario for 2021. So yes, our inflation attached calls have done very well. That was long commodities, that was long industrials, materials, financials, and energy, which are, the sectors that are most benefited from an inflationary environment. So now the question is where to from here, right? So I think for the first half of next year, we should continue to see inflation trending way above the target of 2%, which we, of course, now know is an average rather than a specific target for the Fed. And we're holding our inflation hedge positions, and we're looking for rate-sensitive sectors as well. So we have materials, financials, energy, industrials, and in fact, staples as well on the overweight list.
Talk to us more about some of those rate-sensitive sectors. We're looking at 5- and 10-year break-evens at 16- and 15-year highs. But I am curious, and you talk about stocks being a good inflationary hedge, but is there a point when we start to react to some of the higher yields if we get those?
Absolutely, and yields are, of course, going to continue to trend higher as we see both higher inflation and a Fed that's more likely than not going to hike. Hopefully they hike by the second half of next year. So we are still overweight equities at this point. Underweight fixed income in general. We do have an allocation that we've been promoting for some time to Bitcoin, which of course is also an inflation hedge and has a really nice correlation with the depreciation of the US dollar. But look, I think a lot of us are expecting yields to go higher. I think a lot is already baked into prices, Taylor. We know that the Fed is more likely than not going to taper in a few days' time, in about a week, and end that by the second half of next year. So the question is, maybe the Fed is behind the curve, right? So then we get into the question of stagflation, which I think is not a risk that we need to completely discard for 2022. And in fact, the following year, if the Fed loses additional credibility and perhaps doesn't do what it needs to do ASAP, I think that could be that could precipitate the next correction. So it really is on the Fed, Taylor, to do what it needs to do.
Catherine, if I'm selling bonds and I'm selling credits because I'm worried about the interest rate risk and I'm not really interested in Bitcoin or crypto, what do I buy?
I think you need to have an allocation, as I said, overweight to equities. We're still in a risk-on position while the Fed continues.
Within equities, though, what am I buying? What do I do to provide some balance within my portfolio? Normally that would be provided by bonds, but I need something bond-like in my portfolio. Where am I going?
Understood. Yeah, I think you need to be in the higher dividend stocks. Of course, that would give you what you're looking for. But bond proxies, even utilities, I wouldn't be recommending at this point because of that interest rate phenomenon. So I would certainly say go into the higher dividend, the value, increase your allocation to staples or, to equity sectors that can give you sort of that higher premium and maintain a position in fixed income. We're not saying go whole hog and go into an aggressive portfolio, but you should be overweight equities at this juncture and underweight fixed income in general.
Catherine, Guy said that he wasn't going to be in Bitcoin, but what he might not know is you're in Miami, and maybe we're going to be calling that Bitcoin capital, at least for now. It was Paul Tudor Jones saying that Bitcoin might be a better inflationary hedge than gold. Do you agree?
Well, the market agrees, right, Taylor? Because gold has suffered, has been a detriment to Bitcoin. Has been horrible for gold, basically. That's what I'm trying to say. It's taken the luster from gold, and Bitcoin is, in fact, an inflation hedge, and that's something that we've both been saying for some time now. There is a correlation with the depreciation of the U.S. dollar. So I do think that Bitcoin should have a place in an investor's portfolio within that alternatives portion of his or her portfolio. So yeah, you should be in both, really. I think gold has a place and Bitcoin has a place in investors' portfolio.
Cathie Rooney of Bulltech Capital Markets. Thank you. Guy, if you don't want Bitcoin directly, you can get the Bitcoin Futures ETF. It is the second one that launches today. We're going to take a look at that next. Lots of interesting stuff I know we're going to chat about. This is Bloomberg. Live from New York, I'm Taylor Riggs here with Guy Johnson in London. Guy, we got to get you on the Bitcoin train. We can at least get you on the Bitcoin futures. ETF trade. He had
Who says
Bitto, of course.
I may be on it. I may be on it. You never know.
You never know. We know Matt Miller's on it. I just have to stalk you on Facebook to figure out if you're on it too. You had the first Bitcoin ETF, as we know, the futures Bitto earlier this week. You have another one today, Valkyrie, of course, trading on the NASDAQ BTF. Let's do it all with Bloomberg's Dave Wilson here with more. Dave, what do we know?
Well, we know that, indeed, the Valkyrie Bitcoin strategy ETF has made its debut. You're not seeing the kind of trading, though, that you are in the ProShares ETF that began trading earlier this week. And let me tell you, it was quite a debut for the one from ProShares. I mean, just look at the numbers. Assets under management exceeding $1 billion in 2 days. That's the fastest for any ETF ever, according to Bloomberg Intelligence. You looked at the trading volume, $1.2 billion of shares changing hands in the first 2 days. And you just go through, an inflow of $567 million on the first day. Now, we should note that, indeed, the ProShares fund is down today, got below $40 for the first time since it began trading. Nonetheless, the activity is really there in that ticker BITO, more so than we're seeing in BTF. And there are spillover effects when you look at, where venture capitalists are putting their money. Certainly, they're looking at cryptocurrency and trying to find ways to take advantage of that market. And then beyond that, what we've seen already, you could argue is just the start. We're due to get another Bitcoin futures ETF from Van Eck next week. Galaxy Digital, Michael Novogratz's firm, also has one in the works. In fact, it's getting so active that Invesco actually withdrew its proposed Bitcoin futures ETF just before it was supposed to start trading.
I think Wagner actually probably is the right theme tune to all of this, the Ride of the Valkyries. Let's talk a bit about bigger being better. There is a problem when these funds get too big, in as much as they start having to move into different futures, and as a result of which the roll costs increase significantly. Is there actually a size problem already?
That may well be the case, Guy. Because you got J.P. Morgan kind of pointing out your argument in terms of what's happening with the particular Bitcoin futures ETFs as they buy contracts. You look at numbers in terms of ProShares, and that they certainly are in the November contract more so than October, which expires next week. And there are all kinds of concerns that J.P. Morgan has about the potential distortion of the futures market.
Dave, we're going to leave you there. Thank you very much indeed. Dave Wilson on what's happening with these ETFs. Wow, what a wild ride it has been. Coming up, talking of another wild ride, gas traders watching closely what NOAA has to say about the weather forecast. We'll talk about that next. This is Bloomberg. From London, I'm Guy Johnson. Taylor Riggs over in New York. This is Bloomberg Markets. Taylor, I've always wanted to be a weatherman. This is my moment. We get to talk about the weather, which is every Brit's kind of genetic desire.
I'm scoring you, so give me your best.
Okay, yeah, marks out of 10. Okay, basically, this is the way it's going to go. We have a situation which is pretty similar to last year for the United States. This is the NOAA forecast, which we got yesterday. We're still in La Nina, which is pretty similar to last year. The big concern, of course, is we see some of the huge weather events that we got last year continuing into this year. But this is the kind of the broad brush story. So let's start off here. Basically, the broad outlook is drier, but we're going to be wetter up here in the north, and that's going to creep down into Northern California, which is good news. Your part of the world, we are going to get potentially some wetter weather there, so that will improve the situation, but still dry down here. So we are going to see that continuing. This area of the United States likely continue to see hot weather, dry weather, and that's going to continue to be problematic. But the real story really is what's going to happen are we going to get a continuation of what we got last year? Remember last year we had this huge polar vortex which came all the way down into Texas and caused that really big deep freeze that Texas experienced and the huge implications in terms of heating and energy that created. Are we going to continue to see some of the problems that we've had in California persisting? Well, maybe there's some optionality there, but this is a very vague weather forecast, and the real kind of story is in the tails. What do the tails look like? The central forecast looks pretty similar to last year, but are we going to see those tail events coming through?
10 out of 10. Our producers say you are the best weatherman that this show has seen today.
Today? Oh well, that's ringing. That's a ringing endorsement if ever I heard one. But it is so Taylor. But this is we joke, but this is actually going to be one of the critical stories for this year. We have an energy crisis, particularly over here in Europe. How are we going to have enough gas? It really is going to depend basically on the weather. Is this milder weather going to mean that actually the heating gets turned on a little bit less, that there are more supplies globally in terms of gas that can be distributed around the world? This is going to be absolutely critical. So we need this warmer weather to actually become a reality. If it doesn't, Europe could be in real trouble. I think you guys over there are probably in better shape. But nevertheless, these weather forecasts are now critical for the markets.
They are, Guy, and indeed, I think we have a man who can talk to us about this a little bit more. It's John Gottschalk, NOAA Climate Prediction Center, Chief of Operational Prediction Branch. And you just heard, of course, Guy, giving us a very, very good breakdown of really what sort of the rising nat gas prices have meant. Is it going to be offset, any of it, by perhaps maybe fewer cold days on the horizon?
It's a great question. As was noted there, we're generally favoring above normal temperatures along the southern tier and across much of the eastern half of the nation or a third of the nation. But during La Nina events, there's typically more variability or more changeable conditions. We saw that last year in the month of February, where during December and January, much of the continental U.S. was quite warm. It was above average, but within the span of 2 or 3 weeks, we had that cold surge, as was mentioned, across the plains into Texas, and pretty much totally impacted the energy concerns much more than the first 2 months. So with this given La Nina event that we have now, again, very similar overall forecast. But the likelihood of another extreme event like that predicting at this sort of time range is really not reliable per se. It's not something that won't happen, but we also can't say for sure that it will. So in general, for the most part, just very changeable conditions expected across that battle zone area in the plains and also the Great Lakes. As we move closer to that's more likely to occur similar to last year later on in the winter, say January and February, when influences from the stratosphere often can change the higher latitude variability such that you're more likely to get extreme cold air outbreaks in the central and eastern United States.
The critical question that a lot of people in the financial markets are trying to work out is what is demand for gas going to be as we go through this winter? That's what we're all trying to figure out right now. Nat gas is pretty scarce around the planet. What do you think in terms of your expectations for the number of days that we're going to have the heating on? What does that look like?
Well, in general, like I mentioned earlier on in the winter, we do think the demand for heating with respect to the eastern United States will be somewhat limited. The greater threat or concerns as we get into the later part of that December through February period that will switch more zonally across the northern tier of the United States, including the Northeast, New England, the Great Lakes. Earlier on in the period, as you can see, we're favoring below normal temperatures in the Pacific Northwest and also the Northern Plains, Northern Rockies. And so there will be some impact there earlier in the winter. But it's hard to say for sure exactly how the sub-monthly or sub-seasonal variability cold air outbreaks will eventually play out. But we're thinking later into the winter would be much more of a higher demand, not only for the later in the winter months, but also potentially more options for below normal temperatures over longer periods of time.
And John, you're sort of hinting at this. What is the reliability of that forecast?
Exactly. It's a great question because during the first part of the winter, we feel like we have more confidence. We do think things will tend on the warmer side compared to normal across many of the eastern cities in the Southeast, for example. But if you, the future seasonal outlooks that we had released yesterday that go through the winter and the early spring, you'll notice a much greater decrease in the probabilities or the odds for above normal temperatures. They also sink further to the south, with some of the below normal temperature favorites shifting to the east to more of the central northern plains and even parts of the western Great Lakes. And then even more so with the uncertainty. So the reliability in the forecast, the certainty as we get later in the winter in March, when we often have these cold air outbreaks, at this forecast lead is quite high. Early on, though, we feel have a little bit more confidence and perhaps a little bit less demand in those areas.
John, what is the read across into the wider northern hemisphere from what you can see happening in the United States?
Well, it will depend so much on whether we, and I'm talking about later in the winter now, is that for the U.S., you saw our general prediction. But one thing that we have noticed further back to the west across parts of Canada and Alaska, a much colder, we're favoring much colder events in temperatures than last year, quite especially across Alaska, for example, Western Canada into the Pacific Northwest, more cooling it down across the west coast of the U.S. It will depend very much, as you noted earlier, on how the stratosphere will impact some critical modes of variability in the climate, such as the Arctic Oscillation or North Atlantic Oscillation. During those sort of polar vortex type events, the circulation in the higher latitudes or the pole region can be more wavy, and it increases the likelihood of extreme cold events, both not here in the U.S., but also across Europe and Asia in general, because of more blocking in the North Ocean areas of the Pacific and the Atlantic.
Really appreciate it. John Galchuk of the National Oceanic and Atmospheric Administration. Really appreciate it, guys. We're taking a look at weather events. I mean, really here in the U.S. and, of course, in your UK. And what it means has historically been high energy prices. And, well, all of that has been folded into good news for some of the industrial companies. But our next guest says this current crisis, it could be a different story. Cameron Dawson, Field Point Private Chief Market Strategist. She's next. This is Bloomberg.
This is Bloomberg Markets. I'm John Hyland, and you're looking at the Principal Room. Coming up, BlackRock's Rick Reeder and Invesco's Christina Hooper join Wall Street Week. That's at 6 p.m. in New York, 11 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News now. I'm John Hyland. The Federal Reserve says it will ban top officials from buying individual stocks and bonds, as well as limit active trading. The move follows an embarrassing scandal that led to Fed departures and clouded Chair Jerome Powell's path to renomination. Some Fed watchers say Powell's quick action to enact stiff trading rules for senior Fed officials could improve his chances. And Britain's Queen Elizabeth II spent one night in a hospital for checks this week after canceling an official trip to Northern Ireland on medical advice. Buckingham Palace says the 95-year-old went to a private hospital in London on Wednesday for what it called, quote, preliminary investigations, and that she returned to Windsor Castle on Thursday and is in, quote, good spirits. And authorities are investigating after confirming that actor Alec Baldwin shot two people, one fatally, in an incident involving a prop gun on the set of a film in New Mexico. The movie cinematographer was killed and the director wounded. A spokesperson for Baldwin described it as an accident. Production on the film has been stopped. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm John Hyland. This is Bloomberg. Taylor?
Thank you, as always, John. I want to bring you some breaking news, you guys, because we did know, of course, that Nancy Pelosi and Chuck Schumer were meeting with President Joe Biden, trying to get an agreement towards the economic agenda. Some of the headlines coming out of that meeting is Pelosi has said that she is positive and very optimistic, saying that they are close to a deal on spending. It is close. They're talking about possible votes next week, and there are some outstanding issues over health care in that Biden plan. Again, coming out of that meeting with Biden and Pelosi, saying that they're hoping that a deal is close and they are optimistic. We'll bring you more news, of course, as those trickle out. Let's take a look, though, in the meanwhile, guys. Some of the industrial giants, namely this one, Honeywell, the company beating on adjusted earnings per share, but missing on profits and cutting the sales forecast for the year. Joining us now, Karen Ubelhart of Bloomberg Intelligence. Karen, always so smart. Love it having you. What are you hearing about the impacts of some of the cut in that full year guidance?
They can't ship because they can't put, they're missing components. They're having a lot of shortages. It's a known thing that this was going to be an issue. I think the question about supply chain now is how long will it persist? Honeywell never cuts, but this isn't their fault. If you can't make the parts, you can't get the parts, you can't make the equipment. So they performed on margins as they always do, and that's how they make it up.
Karen, we'll leave it there. Thank you very much indeed. It's going to be interesting to see how many of these other industrials are talking about similar sort of narrative. Karen Ubelhart of Bloomberg Intelligence, greatly appreciated. Let's carry on the conversation now. Field Point Private Chief Market Strategist Cameron Dawson joining us. Cameron, every earnings call that I'm listening to, every report that I'm reading is, particularly from the industrials, about two things. What is happening on the input story, and that is basically kind of labor, energy, supply chains on one side, and just super strong demand on the other. Let's talk about the input story for a while. Cameron, do you think that these companies can continue to pass on the higher costs that they're seeing at the moment? What would normally happen when we start to see rising costs? How would they deal with it?
So there is no sign that these companies are having trouble about passing prices on to customers. The companies that have reported thus far in earnings season are putting up some pretty incredible pricing numbers and even saying that pricing into 2022 will be really strong. Take a company like J.B. Hunt, who's saying that they think that they can get high single digits to low double digit price increases for intermodal next year. So at this point, there's no sign that those customers are pushing back on higher prices. But what we need to look for is in the orders numbers to see if we're reaching that pain point where customers are saying enough is enough. At this point in orders, we're not seeing any evidence that customers are pulling back on spending, but there was something very interesting that came out from the Philadelphia Fed Manufacturing Survey yesterday. So that orders number still remains very robust and near all-time highs. But if you look at the survey question about orders in the next 6 months, that number actually plunged this past month. So it's not enough to call a trend or to say that this manufacturing cycle is over, but we really do need to watch to see if there's any more signs that orders are starting to slow down.
What is that breaking point in terms of prices? As you said, if these companies have the pricing power, when do you think we get to that point when consumers start to push back and say, maybe not?
So it depends who you are and what kind of margins you have. We're not seeing in the US signs again that we've reached that breaking point, but in the UK, we are. If you are a low gross margin producer, or if you are somebody that doesn't add a lot of value into what you're manufacturing, what you're seeing is that energy prices are enough to cause you to curtail production. So think of things like fertilizer, glass manufacturing, aluminum smelting. We're seeing that kind of production get cut. But if you are an industrial company in the US, you have really high gross margins, and let's say you play in niche areas where you have really strong pricing power, in those areas, you're not having trouble pushing prices through. Now, you are exactly correct that we need to watch the consumer very closely, because the consumer really is the end of the line for price increases. They have no one else to pass that price increase on to. So if we start seeing fraying in consumer spending, then that could be a sign that things are slowing down overall. The interesting thing there is that we've all been talking about the University of Michigan Consumer Confidence Survey and how consumers are saying it's no longer a good time to make big purchases. But we're not seeing it show up in a big hit to retail sales yet. So it's something that we have to watch, but we're not seeing it yet in the sales.
In terms of what would normally happen at this point, you would normally see, so I spend a lot of my time talking about airplanes. You would normally see if energy prices start to go up or input prices go up, the companies within the aviation sector would look for more efficient ways of doing things. They'd buy more efficient aeroplanes. They'd figure out how to manage their fuel costs a little bit better. To what extent is this time going to be different?
So Exactly. We usually do see this trade up into better efficiency type of equipment. And we also usually see a big boom in energy capex related to higher oil and gas prices. But what could be different this time is that those industrial companies that typically benefit from better fuel efficiency, better kinds of efficiency things, if their customers can't get their hands on to order that higher fuel economy truck, it really doesn't make much of a difference if you can't deliver it. The other part of it is that energy companies really aren't spending on capex like they have in prior times where we've seen big spikes in oil prices. And there's a few reasons for that. One, we know that there's ESG mandates that are causing companies to divert investments from fossil fuels into more green investments. But the really important one is that equity investors in those energy companies are going to the energy companies and saying, hey, we don't want you to spend as much in capex. We want you to live inside your cash flows, essentially don't spend more than you're making. And we want you to take all that cash that you would normally generate and give it back to us. So companies are now saying, hey, instead of increasing capex to get benefit from higher prices, we're actually going to appease our equity shareholders, because if we don't, we could get our multiple hit. So we're not seeing that same kind of increase in capex, which would normally be good for industrial companies, but likely is going to be more muted this cycle.
Is it going to be good for investors, though, as we're thinking about a return of cash to investors versus investing in the company?
I think in a sense, yes, because you won't see, hopefully, the same kind of boom and bust swings where you've got really profligate spending at the peak of a cycle. So hopefully we'll see a little bit more discipline through these cycles on the investment spending. But there's something really important to note from these energy companies, which is the reality that rig count since the peak in 2014, when we had the frac boom, it was right before the industrial recession. Today's rig count is 75% lower than it was in 2014. But the crude oil output is actually 30% higher in the US than it was in 2014, which means that we're generating 30% more crude with 75% fewer rigs. So in your question about, is this good for investors? In a way it is yes, because we're proving that we can do more with less.
Cameron Dawson, Field Point Private Chief Market Strategist. Really appreciate your time and your thoughts there. Thank you. We're gonna have much more next, Guy. This is Bloomberg.
Time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm John Hyland. China Evergrande Group has made an interest payment on a dollar bond ahead of tomorrow's deadline. The company is said to have wired the $83.5 million payment, which offers temporary relief for the world's most indebted developer, giving it time to sell assets and raise cash to pay creditors and suppliers. Analysts say more than $300 billion in liabilities is still owed. And the U.S. Department of Justice is accusing Ericsson of breaching a $1 billion agreement it made with prosecutors in 2019, ending a corruption probe. The company says U.S. prosecutors told the Swedish telecom network equipment manufacturer that it had failed to provide documents and information to the DOJ, and that Ericsson will now be given an opportunity to explain the breach. And Renault will lose out on far more car production this year than previously anticipated due to the crippling global chip shortage. The French manufacturer says it will make close to 500,000 fewer vehicles in 2021 due to a lack of components. Renault had previously predicted a shortfall of roughly 200,000. And that's your Bloomberg Business Flash. Guy, Taylor?
John, thank you very much indeed. In a moment, something you do not want to miss. Coming up on the European close, my good friend and colleague Francine Lacqua will be sitting down with the Fed chair. Jerome Powell, the South African Reserve Bank Governor, Lesetja Kganyago, and Augustin Carstens of the BIS. That is coming up shortly, Taylor. It's interesting. Today we've seen the Russian central bank significantly outperform expectations on the upside when it comes to rates, 75 basis points. The expectation is that South Africa is going to be following, maybe 25 this year, maybe 50 this year. The big question is, what about the Fed?
Well, and coming off of the PMI data that we got this morning, Guy, and then the reaction function of a 5-year and a 10-year break even that are now going back to 15-year highs. And this idea that the markets are seeing inflation that might not be transitory. The Federal Reserve continuing to say it is, and they're not behind the curve. And you really wonder how we start to digest all of the inflationary data, Guy.
Are we going to be in a wait, hurry up kind of scenario, i.e. they leave it late and then have to move more aggressively? Markets starting certainly to figure that out as a possibility. We're going to dive deep into all of this in the next hour. Really looking forward to this panel. We'll bring it to you live in the next few minutes. This is Bloomberg.